The Starbucks bear case just changed. The bigger story now is war-driven inflation. The U.S. Iran war has disrupted the Middle East energy system, driven Brent crude above $100, and shaken consumer confidence. That matters because higher oil becomes higher gasoline, freight, utilities, and packaging costs across the economy. This is cost-push inflation. When households spend more on fuel and essentials, they have less room for premium discretionary habits. That is where Starbucks becomes vulnerable. March consumer sentiment fell to a 3-month low as inflation fears rose with the Iran conflict. Fed Vice Chair also warned sustained energy prices could hurt both inflation and spending. Starbucks then gets hit a second way. Its own cost base can rise through freight, energy, distribution, and already elevated coffee costs. And this is landing on a company that already showed the problem. North America traffic improved, but operating margin fell to 3% in the first quarter of 26 from 8% a year earlier. So the mechanism is simple. War lifts oil, oil lifts inflation, inflation squeezes the customer and Starbucks at the same time. That is the double squeeze. This is when optimism becomes fragile. If costs rise faster than cash flow, the market stops paying for the story and starts paying for the earnings risk. We're seeing this across many stocks right now. The S&P 500 is starting to break lower, especially for Starbucks stock. You can see significant support just cracked and made a meaningful push lower on Friday. Does it trade down to wedge support uninterrupted or snap back higher? Bigger picture, when we zoom out and take a look at price action, Starbucks has been struggling to advance higher for years. One thing seems clear. If the war puts a big squeeze on fancy coffee drinkers' bank accounts, then the stock could have a lot more room to fall. The real question is, how much longer will inflation persist, and will high-end coffee drinkers really care?